Hey everyone, thanks for joining. We'll just give it a minute or so before we kick off. I think in the interest of time, and I know Dan and David have some really excellent content to share. Let's get started. Good afternoon, everyone. Thank you so much for joining us for the second session in our quarterly webinar series in collaboration with our friends and partners at US Expansion Partners and Wilson Sonsini. Just by way of introduction, I'm Alex Donker. I'm Relationship Manager here at HSBC Innovation Banking, where we focus on supporting technology and life science businesses with a full suite of banking products, regardless of stage and scale of the company. And of course, that includes international expansion. Today, we have an exciting session which focuses on the timing and execution of expanding your business in the US. Like I said before, Dan and David have a wealth of knowledge and experience to share. So much further ado, can I hand over to you, Dan, just to introduce yourself?
Sure thing. Hi, everyone. My name is Dan Glazer. I head up the U.S. Expansion Group and the London office at the Silicon Valley headquartered law firm Wilson Sonsini. Our team works with UK, European, and other non-US startups through their US life cycle, launch, scale, raise venture capital, and then exit through M&A or IPO in the United States. I'll turn it over to David.
Thanks, Dan. Hi, everyone. I'm David Rose. I'm the CEO at US Expansion Partners. I'm a longtime operator here in the US. I've done 5 venture-backed startups, and I'm a 3-time CEO. And our firm helps growth companies launch and scale in the US. We're going to break our webinar down today into 2 sections. The first one would be how to think about US expansion, like when is the right time, what are the signals for that? And then Dan's going to take the how. So like, okay, you've made the decision to go, what are the steps? And so those are kind of the 2 segments we're going to look at today. So let's go ahead and jump into it. These are things you're probably acutely aware of. I mean, most companies who aspire to be a market leader in their segment are eyeing the US market, just kind of given the size of it. It's pretty huge in all metrics you can think of, whether you're selling direct to consumers or to B2B. It's a $26 trillion GDP economy, and there's over $300 billion in venture capital distributed every year. And of course, we all aspire to be listed on the New York Stock Exchange or NASDAQ, publicly traded exchanges at one point. When it comes to thinking about when is a company ready for US expansion, we think about it in 2 parts. First, we want to take a look at the assessment of the current state of the current business, and we're going to get into how to think about that. And then secondly, you want to think about preparation for US expansion. There's certain steps in preparation you need to be doing before you ever set foot in the US. So let's first take a look at how to assess the current state of the business, kind of a due diligence approach. The first thing I would talk about, or the first signal I would look at, is let's make sure you have really strong product market fit signals in your home country. If you're in the UK, you want to have really good product market fit signals in the UK before coming to the US. The product market fit in the US will definitely be different from your home country. And what you don't want to be doing as a startup is trying to figure out product market fit in 2 countries or 2 territories simultaneously. That's a really tough task that's very problematic. So first off, just make sure you have product market fit in your home country is a good kind of starting point. Look at your overall revenues. If you're If you're, doing, north of $1 million or $2 million in ARR, that starts to be a material amount of revenue that might make sense to look at. If you're doing 100,000, again, you probably haven't proven product market fit. And you want to continue down that path. Another way to kind of assess the current state is if you really dig into your TAM numbers or total addressable market numbers, if you break that down by region and the US market makes up more than 50% of your TAM, you probably ought to be making steps to move to that market, just kind of given that opportunity you need to chase. Another thing you'd want to look at is capital requirements. It's typically very expensive to come to the US. And so don't come if you're not financially prepared to do so. We're going to talk about budgeting here in a minute. You want to look at your exec team to make sure you have enough bench at the parent company to make sure that the business runs properly and continues to grow there while the founder kind of turns their attention to the US market. We're going to talk a bit about that. And then are you getting demand from the US? Are you having customers? Do you have existing customers? Are you getting inbound leads from the US? That's another way to think about kind of current state and our due diligence. And so once you kind of look at these signals and kind of say, okay, all these things seem to make sense, let's start thinking about the US. Here's a few things you'd want to think about from a planning perspective. I'm a really big believer in that the founder is really critical to leading US expansion. We talked about it a moment ago, but the product market fit in the US is going to be a little bit different. And I'm a firm believer in that really the founder has the unique insights needed to identify product market fit. So you're not really going to be able to go to the US, hire a chief revenue officer and scale. You really kind of got to start over. So the founder needs to come be on the ground in the US. They don't necessarily need to move there, but they need to be the person there doing their first set of deals, identifying the product market fit. They need to be part of the site selection process. They need to be building strategic relationships. And so the founder needs to really be the leader of the US expansion initiative. This why it kind of goes back to the team. You want to make sure you have a team in the parent company who can continue to manage and grow the business at the core while the founder turns their attention to the US. Another part of the planning process for the US expansion that's really key is the site selection process. There are a number of variables that go into finding the best location for your company in the US. I think a lot of companies, especially in tech, think they need to go to Silicon Valley or they go to New York City because there's a familiarity and they've been there before. But you really want to take a deep look at where your company's going to be located in the US. And these are the inputs you would look at. We have an interactive site selection tool where you can actually put in 10 inputs and it'll give you a market recommendation based on those sort of things. We won't go into all these details. The one thing I will tell you though is the thing we emphasize a lot is how important the time zone is. If your US subsidiary is located on the US East Coast, they're going to have 3 to 4 hours of operating overlap with the parent company. And that's really a critical strategic advantage because you can operate at the speed of business in the US. If you're on the Pacific time zone in the US on the West Coast, anytime a question comes up about product, people, pricing, et cetera, you pretty much have to wait a day to get an answer. So being on the East Coast is a strategic advantage. But on the site selection process, the reason this is important to think about up front is where you're located in the US is going to have a material impact on the cost of your US subsidiary. So for example, if you are in New York City, it's going to be much more expensive than if you're located in Atlanta, Georgia. And you want to think about that ahead of time because the next kind of critical step in the planning process for US expansion is putting together a detailed pro forma financial model and budget for the US. So the reason this is really critical, this is your operating plans. It's going to include on the revenue side, all of your assumptions about the US. What is your average sales contract value? What are the sales ramp-up periods? What's your annual sales productivity on a per rep basis? How many customers are you going to churn there? So how much revenue are you going to generate? And it also takes into consideration all your expenses. This goes back into needing to know the site selection for your office or US subsidiaries, so you can kind of plan the expenses accordingly. So you would put all your revenue assumptions and all your expense assumptions into a pro forma financial model that would tell you basically how much capital you're going to need to expand to the US because you're probably not going to be profitable on day one. So again, a really important step is when you're thinking about coming to the US is spending time before you ever come to put together a detailed US specific pro forma financial model that includes all your revenue assumptions and all your expense assumptions. So you really know what the capital requirements are going to be going forward. Another thing that we talk to companies about quite a bit in the US is talent readiness. Most companies, when they first come to the U.S. for the first time, they aren't ready for the talking to the U.S. employees and are unprepared typically for just how savvy U.S. employees are around the employment process. And so a common mistake would be you're going to come to the U.S., so you either hire a recruiter or you post a job on LinkedIn. You get someone from your sector who has a great track record and a great CV, and you set up an interview. And you get into the interview and they're immediately going to start asking you questions about, great, who's your health insurance provider? And you're going to say, I don't know. And they're going to say, what's your 401k contribution strategy? And you're going to say, I don't know. And then they're gone. I can't emphasize enough how competitive it is to hire talent in the US. And your company really needs to be ready to ever have your first interview if you're going to land really, really top talent in the US. So in the US, you've probably heard this. There are not contracts when you hire someone. It's employment at will. And employees can leave anytime they want, and employers can terminate people anytime they want. So you'll find it's a lot more dynamic in the US market. And people can come to you without any kind of contractual baggage or kind of timeframes where they have to wait. So we typically in the interview process, they're ready to make a move. So just make sure you've done all your homework and you have an idea of what the compensation is going to be, all their HR policies, all these sort of things you're going to know ahead of time before you ever start your first interview process, just to make sure that your company is ready to compete for talent in the US market. One other thing to think about from a planning perspective, when you come to the US market, we talked a little bit about product market fit, but I think it's really important to do some extensive planning around your US go-to-market strategy. Again, product market fit is going to be different, but I think a common mistake when people come to the US, they're going to interview someone, a US salesperson who's been working in their sector for some time. They might have had a really great track record around sales and said that they might have sold $5 million in ARR last year. And there's an assumption if we hire this person, this really fantastic salesperson from the US, they're going to generate $5 million in ARR for us next year. And what you don't realize is the reason that a lot of these US reps really have high sales numbers is that there's almost always a super sophisticated demand gen, lead qualification machine behind them, giving them leads. And so that's why they're able to operate at a really high level of sales. And so if you're going to come into the US market and compete in the US market, you really have to be prepared for figuring out how you're going to do demand generation, how you're going to do lead qualification, how you're going to do all your sales motions. All these things need to be figured out ahead of time. What you don't want to do, because US salespeople are very expensive, you don't want to hire someone with a very expensive salary and then have to figure all this out afterwards, because those salespeople are going to immediately be looking for leads. And if you don't have a lead pipeline already up and running before you hire them, they're probably not going to stick around because they're not going to be able to make the sales they need to earn the commissions they expect to hit their total earnings cap. But anyway, those are the kind of the things we talk to companies about before they come. Okay, what's your current state? And then let's talk about some of these specific areas around, the site selection, around talent, and around go-to-market. And let's make sure you're thinking about all those things before you actually come to the US to give you a much better chance of success once you're on the ground here. So those are how we think about like the win. And now Dan is going to talk to you about the how. So now you've made the decision, all these things check out, you're ready to go. What's next? And so Dan's going to talk us through how to actually expand to the US. Dan?
Great. Thanks a lot, David. So the bright red line of when you need to start creating some proper structure around US expansion is when you're hiring employees in the United States, right? That until that point, especially if you're selling in remotely, if you are hiring contractors only, if you're just traveling back and forth periodically, you don't need to put much, if any, structure around it. Like, for example, you can hire contractors out of a UK or European parent entity. You can sell to the United States with some very limited exceptions. You can sell to the United States out of a UK or European entity. But but you really don't want to hire employees in the United States through a non-US entity for three reasons. tax, liability, and ambiguity of employment rules. From a tax standpoint, if you hire U.S. employees, let's say through a UK company, as an example, then you're creating a risk of creating what's called a permanent establishment in the U.S. In other words, a taxable presence in the U.S. where the U.S. Tax authorities, the Internal Revenue Service, will be, laying claim to the same income as as your local tax authorities, HMRC. If you hire employees through a parent company in the UK and Europe, from a legal standpoint, you end up having a direct line of potential liability for anything that the individual does, or the employees do, back up into the deep pockets of the company, right? Rather than the subsidiary going right to the UK or European parent company. And then finally, ambiguity of employment rules. There are obviously certain rules governing the treatment of employers and employees, but employers in the home market in the UK and Europe. But then there's also rules governing the treatment of employees in the United States. They don't necessarily match up. So if you have a UK or European employer and a US employee, it gets a little bit ambiguous as to what happens in the event of a dispute, right? So you decide to go ahead and hire U.S. employees, and this list here, under the how to expand to the U.S., this highlights sort of the checklist of the structure that you would look to put in place, and I'll go through this item by item. So typically, if your first step in the U.S. is to hire locally, typically the initial undertaking is to create a company in the US. And typically that's going to be a subsidiary wholly owned by the UK or European parent company. You might have heard of something called the Delaware Flip, which is to create a US parent company over your existing UK or European company. You generally don't need to do that simply to hire employees in the US. The rationale of creating a US parent company is tied to raising money from US investors who, at an early stage, typically at seed, sometimes at Series A, may require a US and specifically Delaware corporation as a parent company in order to fund the business. But if you're simply expanding to the US without raising money from earlier stage US investors, then that can typically be done through a US and specifically Delaware subsidiary. And so it typically ends up looking like a Delaware corporation subsidiary of the UK or European limited company. Why Delaware? The headline is Delaware reduces friction, right? That a disproportionately high number of companies in the US are incorporated in Delaware. It is essentially our de facto national US company. There's no such thing as a national US company. In the same way there's, for example, a UK limited company. There's no equivalent as a US company. But Delaware long ago set itself apart as the go-to state for incorporation in the United States. It has the best corporate governance rules. It has its own dedicated corporate governance courts. Again, it reduces friction. Now, you don't incorporate in every state that you do business in. You just incorporate in one state, and then you register to do business as needed, either from a tax or a legal standpoint in other states as you expand around the US. It also does not mean that you need to hire employees or open a physical office in Delaware. Delaware is a wonderful, wonderful state, but it's simply your state of incorporation, not necessarily where you hire employees or open your physical office. Okay? Most of the time, or maybe I should say often, that the corporate form ends up being a corporation or an Inc. And typically that's for home market tax reasons. The alternative, the most common alternative, is to create what's called an LLC, limited liability company. Now, a corporation is a taxable entity in the United States. In other words, it is taxed for its own activities in the US. An LLC, limited liability company, is by default a tax pass-through entity. In other words, the owner of the LLC, the parent company, is by default taxed for the tax obligations of the LLC. Now, under the tax rules of many European geographies, having an LLC tax pass-through entity creates certain issues under home market tax rules, where a corporation ends up being just a little bit simpler to put in place. Now, I would recommend before you commit to incorporating as either a corporation or an LLC that you talk to home market tax advisors and ask them which is the preferred corporate form. From a legal standpoint, either works fine. It's purely a home market, in other words, French, German, Dutch, British tax issue as to which one is better between corporation or LLC. And then finally, subsidiary, as I mentioned, you'll create a wholly owned subsidiary of the UK or European parent company. So now you've got your Delaware corporation subsidiary. You're going to register to do business in each state where you have offices or employees. So let's say, for the sake of argument, that you hire your first employees in the state of New York. You'll register to do business as a Delaware corporation operating in New York, and you will provide your employees with New York state-specific employment documents. In other words, a New York state-specific IP assignment and confidentiality agreement, which does what it says on the tin, and a New York state offer letter, which has the economics and the financials of the arrangement. And each time that you go to a new state and employ people for the first time, you will engage in those activities over again. So let's say that your next state that you hire in is California. You will then register your Delaware corporation to do business in the state of California, and you will provide California state employment documents. Now, there may be temptation to simply cross out New York and write California, and I would recommend that you resist that temptation. It's a little bit like taking your, let's say, your French employment documents and crossing out France and writing in Germany, because each state in the US has its own unique employment rules. Generally speaking, employment law in the US is state specific, and you do really need to put a state specific employment document in place as you go from state to state. That sounds more complicated than it is. It is expected that law firms will have templates for the different states that you're going to go to, right? So that's under the legal heading. That's setting up the company, and that's employing. And, is one of the things that David alluded to is that your employees in the US, on average, more than you will see in the UK and Europe, are going to be focused on options, right? So you're going to want to make sure that you set up an appropriate option plan for US employees. And the options will always come out of the parent company, never out of the subsidiary. If they come out of the subsidiary, you have essentially created a joint venture, mostly owned by your parent company, and now slightly owned, a small percentage owned by the employees in the U.S. But also the value of the enterprise is at the parent level, and your U.S. employees will quite quickly realize that if you give them options in a subsidiary, that they've got options in a company that doesn't and probably won't ever have much value. Right? Most importantly, when you provide options to U.S. employees, you need to get what is called a 409A valuation, right? And that is a specific valuation of the enterprise provided by someone qualified to provide a valuation in the U.S. that is going to meet the U.S. Internal Revenue Service's standards for valuations for purposes of providing tax-advantaged options to U.S. employees, right? If you try to provide U.S. tax advantage options to employees without a 409A valuation, you create a substantial risk of there being tax issues, especially at the point of IPO or M&A exit, right? Now, those are the three core areas of setup when it comes to establishing a U.S. presence from a legal standpoint: incorporation, employment, and options. There's a few other areas that it's worth keeping in mind. Data privacy. If you're collecting personal information from Americans, you'll want to make sure that you're complying with U.S. data privacy rules. GDPR, for example, is not applicable in the United States. Commercial contracts. If you are entering into contracts with companies in the United States, it may be helpful to make sure that they're appropriate for the U.S. market, not just necessarily are they governed by U.S. law or the laws of a U.S. state, but also are they appropriate for the U.S. market? Intellectual property. You want to make sure that to the extent that you have patents and trademarks in your home market and you want to extend them to the United States, that you make the appropriate filings with the U.S. Trademark Patent and Trademark Office. So that's the sort of legal overview, and that's usually where you would start if you're planning to expand to the US by hiring local individuals. Now, what if you're planning to expand to the US by sending people over from HQ? Then you would start typically with looking at visas. In other words, you're going to want to speak with a US immigration specialist and figure out what of the dozen or more categories of visa would be appropriate to send those relevant individuals over from HQ. And you should expect that that's typically a roughly 3 to 6 month process of going through that visa approval, application process. So if the gating item to expanding to the US is we need to get visas for the people that we're sending over, you need to give yourself a little bit more lead time if you're than if you're, let's say, hiring locally. Going a deep dive into the different visa categories is sort of outside the scope of this discussion, but suffice it to say that if you're building a legitimate business in the United States, in our experience, you can usually find some visa category to expand appropriately. So taxes, so I've just highlighted, well, what happens if you expand by hiring people locally? You start with legal. Well, and what happens if you expand by starting with sending people over from HQ? You start with visas or immigration. But what if you expand by simply selling in remotely? And that you typically start with tax, right? As I mentioned, you don't generally need a US company, with some limited exceptions. You don't generally need a US company to sell in remotely, but you should get a bit of tax advice because in principle, U.S. sales tax does apply to the sales into the United States from the UK or Europe or outside the US. And this is not to say that US sales tax is going to be relevant on $1 that you sell in the United States, but it's good to then at least create an informal relationship with a US tax accounting firm to get a sense of when US sales tax will be relevant. And keep in mind, each state has its own sales tax rules. So start to get an understanding of when sales tax will be relevant, because it's a lot easier to get out in front of it at the beginning than to find out later on that you should have been collecting sales tax and didn't, and then on top of that have to pay penalties. Now, assuming, let's say, that you went to the US by hiring people locally or sending people over from HQ, and now you've set up a company, you've set up a subsidiary. The next step after setting up the subsidiary also is tax. You want to speak with a US tax accounting firm to get what's called an employer identification number, or an EIN. And an EIN is your unique identifying number for the company. That is issued by the US tax authorities. And that's what enables you to set up a bank account for the sub and enables you to set up payroll and benefits for the sub. You'll also want to work with your US tax accountant to make certain current and ongoing state and federal tax filings for the Delaware company. You'll want to make sure that you've got business insurance for the U.S. subsidiary, or otherwise whatever business that you're transacting in the U.S. through the non-U.S. parent company. You will find, and certainly we found, that most global business insurance policies by default will exclude the United States because the litigation environment in the United States creates a certain level of risk that looks a little bit different than most other countries around the world. Maybe just give a quick explanation of that, because I'm sure many people have heard that the US is more litigious, but what doesn't get talked about as much as to why the US is more litigious. And it comes down really to one difference, which is that in most countries in the world, if there is a lawsuit, it's loser pays legal fees. Right. In other words, that if I was to bring a claim and the other side won, I pay most or all of their legal fees, which is a common approach in many countries. In the United States, that's not the general rule. In other words, if I was to bring a claim, and the other side won, they still have to pay their own fees, even though they won. And that creates a dynamic where claims have leverage. You can get leverage over other companies, other individuals by threatening legal claims, right? And claims, even claims that don't necessarily have a great likelihood of prevailing, those claims have settlement value because it's cheaper to settle those claims than to go and win those claims and pay the associated expenses. That's why insurance tends to cost more in the United States, because that's a very different approach to risk of your business than you have in most countries around the world. This is usually where I throw out the public service announcement, which is that environment when it comes to litigation is, in my experience, somewhat terrifying to many individuals outside the United States. To which point I always highlight millions of companies create trillions of dollars worth of GDP each year in the United States. So somebody is figuring this stuff out. It's just a little bit different as to what you might see in your home market. Moving on down the list, banking. You're going to want to make sure that your subsidiary has its own dedicated bank account in the United States, and certainly our friends at HSBC Innovation Banking are really good at that. And so you definitely do not want to be have the subsidiary using the same bank for the parent company, the same bank account for the parent company and the sub. You can use the same bank for the parent company and the sub, but to use the same bank account for the parent and the sub can be problematic, because that will create an argument potentially that the parent and the sub are being operated as a single whole, which then could drag the parent company into potential liability in the United States if there are claims against the subsidiary. So you want to keep those separate. HR and admin. It's very common in the United States, as you may know, for the employer to provide for health insurance for employees, as well as retirement benefits for its employees for what's called, let's say, a 401k investment plan, as well as needing to administer payroll compliance, like withholding taxes and the like. Rather than create your own internal HR and admin function, sort of reinvent the wheel for a small handful of employees, it's very common in the US to use what's called a professional employer organization, or a PEO. And a PEO co-employs the employees together with the subsidiary. So it's a joint employment relationship where both the subsidiary and the PEO are simultaneously the employers. And that allows the subsidiary to leverage the PEO's retirement benefits plan, health insurance plan, and payroll system, so they don't have to reinvent the wheel for those small handful of employees. And I should highlight that's distinct from something called an EOR, an employer of record. An employer of record, which has become particularly popular during the pandemic environment and then afterwards, allows you to employ employees in different countries without setting up structure, right? So the EOR, employer of record, employs the employees for you. A PEO, professional employer organization, employs the employees with you. That's the primary difference. Government support. And this is something that we see, frankly, not enough companies coming out of the UK and Europe take advantage of. And that is that each of the 50 states and most of the major cities and counties and regions in the US have economic development organizations that are there to help and encourage and incentivize companies from outside of their locality to expand, set up, and scale in their locality. And they're there to offer things like help finding talent, help finding office space, tax incentives, maybe help finding capital, help promoting the business to potential customers and users. And they all want to hear from you, right? That most of the time, no, there is no too small. If you're committing to building a business and putting people on the ground there, it's worth having a conversation with them. As you may recall, just as an example, many years ago, Amazon ran a process where I think it was about 20 or so cities. It told that they had become finalists in Amazon's search for a second headquarters. And when Amazon finally did settle upon its second headquarters, it got substantial incentives when it did so. And that's the approach here, is to potentially narrow down where in the U.S. you want to go to, and then talk to the different economic development organizations in those regions and see what they have to offer. Marketing, especially from a B2C standpoint, maybe from a B2B standpoint as well, it's going to be helpful to speak to some folks in the US to understand how to position your brand in the United States, because certainly approaches that might work in your home market might not necessarily work in the United States, and it's worth spending a bit of time to understand how to best position yourself to get recognized and to gain market share in the US. Personnel, that if you do need help hiring in the United States, speak to a recruiter. I mean, it is often hard to figure out where to start with hiring, and certainly there are startup-friendly recruiting firms in the United States, and worth checking in on that. And then finally, funding. One of the conversations that we often have with companies in the UK and Europe, at least, is that I think that there's sometimes a perception that you need to raise money from the United States, from US VCs, in order to expand to the US. And the feedback I often get is it feels like a chicken and egg proposition, because the VCs then say, well, unless you expand to the United States, we're not going to invest in you. And I could say, from experience working with companies, that generally speaking, commercialization in the US, operational expansion in the US, tends to come first, then comes US VC funding, especially if we're talking about earlier stage businesses. More often than not, certainly at the seed and the Series A stage, the US expansion funding comes from UK or European funds that are backing a company that has already shown a level of success and promise in their home market, and they raise from UK or European investors on the basis of a US expansion story. They take that money, put it toward US expansion, and if they're successful, it makes it that much easier to raise from US investors on the next round, after the company has proven out US traction and is gaining US market share and showing US product market fit. Okay. Next slide. And I think now we're on to questions. Happy to, certainly David and I are happy to talk about whatever you like to talk about.
Alex is going to moderate us here. Alex.
Yes, gents. Sorry, I was just getting the questions up. Yes, second. We have our first question, and also just a reminder to everyone: if you do have questions, please use the Q&A feature. We do have one question in from Victor, and that is, do you recommend using EORs at all, like deal.com, etc.?
Yep, I'm happy to take that, David, to start, if that's helpful. Yeah. So EORs are a great option, right? And we certainly recommend them all the time. I think that there are two things about EORs that it's worth keeping in mind when you expand to the United States, is that in the US, right, whether someone is an employee or not is not dictated by whether or not they have an employment agreement, right? In other words, you could call me up. I'm based in London most of the time currently, but if I was still based in the US full time, you could call me up and say, Dan, I want you to work for me. And I said, yes. And the next day I start working. I'm an employee, generally speaking, under US state law, even without any documents in place, right? And what that means is that you got to be careful about how people are working for you in the US. Now, one of the most common ways that this comes up is when you hire contractors in the US. And what I often say about hiring contractors is if it looks like a duck and it quacks like a duck, it's a duck, even if you contractually stipulate that it's a goose, right? Like if you hire your CFO in the United States and call them a contractor, that might not pass muster if the tax authorities ever come in and say it looks like you've created a permanent establishment of your non-US business because you've got an employee there. And your response is, well, no, that's a contractor. And the response is, well, no, someone who was called CFO and who's discharging CFO duties, it's kind of hard to say they're a contractor. That's really an employee. And so along those lines, if you hire very senior people through an EOR in the US, there is some risk of having that same issue come up, that they end up being deemed to be an employee of the parent company, which is what you're trying to avoid, certainly from a tax standpoint, right? The second thing to keep in mind, and again, this is just practical consideration, is that US employees on average tend to be relatively savvy around options, right? And there are tax advantaged options that you can provide to employees in the US that aren't necessarily available to non-employees. And technically, an EOR employee is a non-employee. That's not your employee. It's an employee of the EOR. So it can create some challenges by tax advantaged options or options that are as tax advantaged as you might give to employees of a subsidiary. That may not matter in the context of your U.S. expansion, but it may matter in the context of, let's say that you're hiring into a very hot labor market, and you're trying to hire in a very hot labor market, and the relevant employees are very savvy about options. This issue could come up. But I want to reiterate, generally speaking, the EOR model works well, and we've certainly seen plenty of companies expand to the US and do very well with it.
Perfect. Thanks, Dan. Thanks for that. Another question which we had over email was in relation to founders moving to the US. Is that a necessity? Do founders have to move to the US once they do that? Any thoughts on that, gents?
Well, I mean, there's never a binary answer for that. I think it kind of depends is always the answer, but I would say it is critical. And I spoke about it earlier that the founder be on the ground in the U.S. In the initial stages, and they go out and find product market fit and talk to customers and build relationships with investors and hire the team and find the site and those type of things. Do they need to move there? I don't think it's necessarily required, but they need to spend a lot of time there. And so I would say they need to spend, a lot of time, months at a time in the US during the first year to kind of figure out all these product market fit and team dynamics and location piece. But there's lots of companies who go, after they get through the launch process, will hire a team in the US, and then the founder will go back and run the business from the parent. So I'm not sure. I think there's a lot of advantages for them to move to the US, but I certainly don't think it's required.
Yeah, I'm going to jump in and add to that, because definitely that's what we see as well, as at the initial expansion stages. And then I think as the company gets bigger and bigger, sometimes there's a decision to be made. And one of the things that we found over time, working with UK and European companies that, let's say, start out as seed Series A startups, right, in the US, and then some of them eventually become real, even IPO candidates. One of the dynamics that we see over time about founder on the ground, CEO on the ground, is this. If the company at any point in its life cycle believes that the success or failure of the enterprise as a whole is inextricably tied to becoming the market winner or market leader in their sector in the United States, then they are going to have to put someone with CEO level authority on the ground in the United States. Because you cannot win an away match by having your best players back at home. The way that you compete and win, and I mean beat all of your American competitors, is so different than the way that you would win in the UK and Europe, that you cannot do that through the lens of running a UK or European business. But when you think about that, how many companies coming out of the UK and Europe are going to look at themselves figuratively in the mirror and say, yep, the ultimate upside of this business, what we ultimately have to try to achieve is to become the market winner in the United States. I wouldn't say that that's that common, right? But for those who decide that that's the ambition, that's the goal, and anything less, is not quite success, then eventually that's what it's going to take. You're going to need to put your top decision makers in the US to move with the speed and the aggressiveness, and frankly, with the budget of a homegrown American company.
Thanks for that, gents. I really like the football analogy there. That was good. Appreciate it. We have another question in, and the question is: we have an existing EMI scheme in the UK. How closely should the US version of the scheme match this, or are they typically managed from the same scheme?
Yeah, what you would end up doing is creating a non-EMI subplan, right? Which is not that different from what you've already got, but it is going to be a subplan that doesn't qualify for EMI, and it's going to qualify for what's called incentive stock options in the US. Typically, you would use ISOs, and in order to provide that tax treatment that you would get with an ISO, and an ISO is like EMI, except it's for US employees, because US employees obviously don't get the benefit of EMI because they're not UK taxpayers. You need to get that 409A valuation in order to qualify for that special ISO tax treatment. But this is actually pretty straightforward. Certainly with any sort of advisor who regularly does this, and I don't mean this as a plug, but we do this all the time, right? For UK companies going to the US, it is relatively straightforward to create a non-EMI subplan, make it appropriate for US employees, get the 409A valuation, and then you're good to go to provide options in the US.
Thank you. Another question we had over email earlier, just around, I know you touched on this, gentlemen, but just around forming a corporation in the US to raise venture capital and how necessary that is. Do you mind sharing some more detail on that?
Sure. So the entire venture capital ecosystem in the United States is built on a foundation of investing into Delaware corporations. Remember what I said earlier, Delaware reduces friction. Anytime that you ask a US VC to invest in a non-Delaware corporation, you are necessarily introducing friction into the process. You are, to some extent, asking them to create a level of corporate governance risk in their minds, because that's not what they usually invest in. They invest in Delaware corporations. They know their rights and obligations under Delaware corporate law, right? The earlier stage you are, the more likely it is that the VC is going to say, I'm not going to bother investing in you unless you become a Delaware company. Why? Because the earlier stage you are, the more fungible that you are, right? That there are just too many pre-seed and seed opportunities out there for the VC to say that, this pre-seed company, is worth, thinking outside the box and finding, English counsel or German counsel or Dutch counsel, right? Like I can just, they look pretty interesting, but the potential upside is so far down the road that I might as well just invest in a Delaware company. It's just as easy, right? But the later stage you are, the more likely it is that they'll say, you know what? Yes, there's a bit of friction here, but frankly, there aren't that many opportunities that this good. I'm willing to deal with it. And so the way that we see that play out is that I think we see this most often when it comes to UK limited companies, just simply because I'm based in the UK. We see it with European companies as well, but I think in terms of data points, we've got the most data points with UK limited companies, that if you're a UK limited company raising a US-led seed round, and when I say US-led, I mean a US fund in the United States that does not have an office in the UK or Europe. So a US-only fund leading a round into a UK limited company at seed, it's about a 75 to 80% chance that they're going to require creating a US parent company, the Delaware flip, as it were, as a condition of the financing. But by the time you get to Series A, it drops to about 20 to 25%. And by the time you get to Series B, I don't think that we've seen a Series B or later UK limited company have to flip into Delaware to raise money from the US in over 5 years, right? So the way to address this is that, as you know, if you're a UK or European startup and you're talking to US VCs and they say, hey, we're interested in you, but we only invest in US companies. Well, the first thing that you need to do is to understand what they mean. Do they mean you have to be a US company in terms of your corporate structure as a US topco, in other words, a Delaware topco? Do they mean that you need to be based in the United States operationally? In other words, you could have a Delaware parent company, but if you've got, you know, nobody on the ground in the US, no revenue in the US, nothing in the US, you still may not be an attractive investment candidate to a US VC, especially at an early stage. Or do they mean both? Do they mean they're only going to consider investing if you are based in the United States with a Delaware topco? And if it's either, you know, one or three, in other words, if it's either, well, we need a Delaware topco or we need you both to be in the US and a Delaware topco, then what you need to decide is whether the terms that they are going to give you are good enough to warrant the expense, which can be substantial, and the time and the effort to do the Delaware flip, right? To do the corporate reorganization, corporate inversion transaction, where you put the Delaware company over your UK or other European or non-US parent company. But you just simply message to the US, to the VCs, like, VC, you know, if you are truly interested in our business, then we can do that, right? But you don't want to do it without them saying that, yes, that's the only issue keeping us from giving you a term sheet. And if that's the case, then you build the flip obligation into the term sheet. In other words, between signing of the term sheet and closing of the financing, you engage in two different transactions, the flip and the financing. The flip completes first, and then the money comes into the Delaware parent company because the financing documents have been negotiated contemplating a Delaware company, right? And that protects the VC in that they never have to deal with the non-US parent company. By the time that they fund, they're funding a Delaware company. It protects the company in that they don't commit to spending the time, the money, the effort on the flip without a signed term sheet saying that if, as long as they flip, the transaction will complete. In other words, that they will have the funds at the end of the transaction to cover the cost of the flip. That's the way we usually see that play out.
Okay, got it, Dan. Thanks a lot for that. Just a quick couple of questions. The first one is just on the materials from today's session as well as the recording. Yes, so everyone on the line, everything that has been shared today will be sent out as alongside a recording of today's session. And the second question we have is, could you please elaborate a little bit more on the pros and cons of LLC versus Corp?
Sure. So it really just comes down to the tax treatment of, assuming a subsidiary, right? Before I jump into that, the pros and cons of LLC versus Corp at the parent level are massive. It's that, generally speaking, a VC will typically not fund an LLC. You really do need it to be a corporation rather than an LLC to raise capital. But I assume that the question is in the context of setting up the subsidiary. And if you're setting up the subsidiary, I mean, really, there's not that much of a difference other than corporation tends to be easier, number one. And number two, that there is often a tax difference from a parent company standpoint of setting up the LLC versus the corporation, right? Like for example, in the UK, if you have a UK limited company, my understanding of UK tax rules, and again, I'm a US lawyer, I'm not a UK tax advisor, but my understanding of UK tax rules is that if you have an LLC subsidiary, it creates certain ambiguities and complexities under UK tax rules. Whereas if you just create a corporation, it's a little bit more streamlined. But frankly, you can set up an LLC, and though there's a little bit more complexity with it, it's not really a problem, right? Because ultimately, all the action, as it were, in your business is coming at the parent company level, not at the subsidiary level.
Got it. Thank you. Another question here. What are the most common mistakes you see clients or businesses making even though they probably received prior warning. And this gentleman just wanted to know specifically companies moving from the Europe to the US.
There's a long list of those. I'll say a few, Dan, and Dan jump in. So we talked about it a little bit earlier, but I think a classic mistake is, hey, we have product market fit here in our current home country. Let's go to the U.S. and replicate it. And that might look like, hey, we're going to hire a senior executive from our tech sector to launch our U.S. business. But typically, those hires don't end well. They're super expensive. So I think a classic mistake is hiring a senior person in the U.S. to launch your business, and this person may have never done a startup before. So again, a smarter approach, or more pragmatic approach, is to come as a founder, personally spend time on the ground in the U.S., do the first 10 deals themselves, then hire a salesperson, and then grow into it that way. So classic mistake is hiring a senior exec is really common. Another classic mistake is setting up in a really expensive, high-cost operating environment. So people don't necessarily realize the diversity of cost in the U.S. It's a huge place. And so where you're doing business, if you're in certain cities, namely, San Francisco or New York, which are both very popular and great cities, but they're also super expensive to operate there. Super expensive for rents and services and people. And so you can look at other alternative markets that also have access to tech talent and tech ecosystems, startup ecosystems, but have a lower operating cost. So that'd be another pretty common one. And I think one we see is what people don't realize a lot of times when they come to the US is, if you're coming from the UK, for example, you're used to one government entity. In the US, you have a federal government entity, but as Dan alluded to it earlier, there's 50 individual states. And so you have different states where you're going to have different rules and compliance and taxes. And so you might start your company, say in New York, and then you might hire a person in Colorado, and you might have customers in Indiana, and you don't realize necessarily that those all have tax implications. And so trying to keep up with a multi-jurisdiction tax environment, I think is something that happens, because what happens is if you don't tend to that and you get into a situation where you're raising venture capital and you get into due diligence, if those pieces of your business are not squared away, it'll halt due diligence cold, and you don't want to be in that situation. So those are three come to mind. Dan, I don't know if you want to add any famous mistakes on top of that.
Yeah. So I would say the most common mistakes are going too quickly and not going quickly enough. And what I mean by that is too quickly. We sometimes see companies spend a fair bit of money on the United States and go after the US aggressively without any sort of proof that the US is going to be a good market for them. That the best companies we see either go very early to the US, like at the beginning of building the business, and optimize their product offering for the US, or, and this is more common, they are pulled into the US by customer traction and user growth. So that they know that if they spend the money and the time in the US, that they're pushing in an open door. It's the companies that go sort of in the middle there, that they go too quickly, thinking that whatever they build must work in the US because the US is more willing to buy tech. The streets are paved for the VC gold, right? I say that tongue in cheek. That is, it is not necessarily the case, and sometimes they will throw a lot of money at it because the US is more expensive, and then they find that they're not really getting much out of it. That's what I mean about going too quickly. The not going quickly enough is the companies that do get some initial traction there, but ultimately are unable to transform the business in the way that you need to compete and win in the United States. I think that there's a substantial underestimating in the UK and Europe, and I would say, frankly, especially in the UK, given the seeming lack of language barrier, I say seeming, and the seeming cultural similarities, that there's a bit of a shock after the company starts to scale as to just how different it is to compete and win in the United States. Not just get a foothold, but to actually go out and beat American competitors once they start focusing on beating you. Just the pace of how businesses run, the aggressiveness of how business operates in the US, the cost, all of it, right, is that if you really want to compete and win and not just sort of get a foothold, not just make it a revenue source, but actually beat American competitors, it often leads to a level of business transformation that we find that many UK and European companies are either not prepared for or ultimately unwilling to undertake. And that's fine. But it is important to understand that if you want to achieve the level of success that results in beating American companies in America, then you really truly have to transform your business into being an American operated business, which in many ways looks nothing like a UK and European operated business.
Fantastic. Thank you for that, gentlemen. I know we're at time, so I just want to thank you again for all the knowledge you've shared today. Just a reminder to the group that all the materials and the recording will be sent out following the session, and we will be having another session, our third in the series, in about 3 months' time. So thanks again, everyone, for joining. I hope you enjoyed it, found it insightful, and we look forward to seeing you again.
Thanks, everyone.